Hey everybody, Jake and Gino here, and today we're discussing the different market cycles and how you can prepare to take down apartment deals in any cycle. G-Dad, it's no secret. We love buying apartments, but as the market cycle and the economy changes, sometimes you need to adapt your acquisition strategy to stay relevant in all parts of the cycle. We don't like to take time off. We want to buy, and go. So great example. When we were negotiating our first 25-unit multifamily deal in 2012, we used creative financing, specifically seller financing, to cover half our down payment. At this point in the cycle, debt was challenging. People were not super excited about investing their hard-earned dollars into apartments. So it was different, and you had to be flexible and adapt. From there, we continued to use creative financing until we leveled up to purchasing stabilized 150, 300 unit properties. And then the market began to tighten, but we started to raise money. We continued to then do syndications. And guess what? We pivoted again. Today, we're purchasing more mid-sized deals internally and raw land for development because we see that as an opportunity. This is all in response to taking what the defense gives us, okay? AKA the market. We want to remain active. We want to have multiple tools in our tool belt to take down deals in a manner that serves us. So, G Daddy Papa Funk multifamily superstar, please detail for us the different market cycles and what investors should look out for.
No superstar here, just someone with a lot of battle scars and someone who's lost a lot of money, not buying the right asset in the right part of the market cycle. Let's go back and let me share a quick story with you. Back in 2007 in New York, you didn't know that the market was going to explode. I didn't know how to read the tea leaves.
You have a crystal ball?
No, I didn't. I was looking at it. I bought a good asset. Problem is I bought it in the wrong part of the market cycle. I paid too much. I didn't have my CapEx. And that was a problem. I bought that asset with a certain strategy in that part of the market cycle that wasn't going to work. Now, market cycle is important. We've got the 3 pillars of real estate. That is one of our frameworks. Market cycle, debt, and exit strategy. All 3 of those. Market cycle is one of the components of those 3 pillars. Now, Jake was talking about it. There are 4 parts of the market cycle. And there's a macro part of the market cycle, which is for the entire United States. And then it goes down micro. It could be a submarket. It could be a city. And then market cycles even cycle into neighborhoods through neighborhoods. It's really amazing. That's why you need to stay on top of what's going on in your market. And if you're just starting out as an investor and you're thinking to yourself, well, I live, for instance, in Louisville, Kentucky, but I'm going to start researching Nashville, Florida, Texas, you may be doing yourself a disservice because you want to become an expert in that market. When you're first starting out, what you focus on grows. Spread thin, you may not be becoming an expert in that market. The first part of the market cycle is the recession. I guess the recession back in 2008, 2009, 2010, that was the first part of the cycle. Everything starts slowing down. Building is slowing down right now. Asset prices are dropping. Rents are dropping. And the last part of the market cycle in 2008, rents didn't drop precipitously. They dropped, but they didn't drop precipitously. You'll see a lot of more foreclosures going on. That market is starting to slow down. What you do see is that's the buyer's part. That's when you want to start buying these assets. The problem is there's not much money and debt pulls back. So it's very challenging back in that recession. The second one, I like to call the recovery. The recovery is all of a sudden markets starting to recover. You're starting to see building starting to take place a little bit. There's a little bit more consumer confidence going on. Rates, depending on all of the different market cycles, you may see rates recovering a little bit. What you're going to see is occupancy for sure recovering. People are starting to rent now. You're starting to see cap rates starting to drop right now, and you're starting to see rents rise in the recovery. The third one is expansion. Expansion, all of a sudden things start expanding. You're seeing rents starting to grow. You're seeing capital starting to flow into certain markets. Cap rates are starting to compress even further. And the fourth one is hypersupply. Hypersupply is, man, the party is going. You've got maybe 1,000 multifamily units being delivered into a market, but only 500 are being absorbed, right? That's not really good for pricing. So the expansion is, things have been expanding, things have been going really good. And hypersupply, this is when everyone starts getting greedy and they start overbuilding and they start overpromising, and there's so much delivery going on in the market and the market's not absorbing. Now, I don't know what's going to happen in this part of the cycle because we were just on a podcast with another gentleman talking about housing. And in certain areas, You may think it's hyper supply because you're seeing a lot of houses being built, but you really need to know the demographics. Are people moving into it? And are they being
saying there's a
absorbed?
deficit nationwide right now? The guy that we just had on is saying there's a deficit of homes nationwide that's going to continue for 10 years, a big, difference from '08.
Let's pull that back. Why did that happen? Because in the market cycle between '08 and 2011, 2012, there was no building going on. The recession lasted a lot longer in a lot more parts of the country. So when you go back, you still see people,
second order consequences.
You're still seeing people born. You're still seeing immigration happening. Population is growing, but there's no assets coming online. And then eventually when they do start coming online, you're still building normal. And to compound things even further in this part of the recovery, in this part of the market cycle right now, you have supply chain shortages. That's the other problem.
Makes it more challenging to build.
You're not even able to build right now. So you really need to understand market cycles because like Jake said, in this part of the market cycle.
Demographics specifically.
Yeah. Yes, you have properties that are older. Back in the 60s and 70s, they were built with properties that are newer. Those older properties, you're paying around the same cap rate, 5.5, as opposed to a newer asset, you may be paying 4.5. You just need to be careful with the capital expenditures that you need to do on these properties. So when you're looking at this part of the market cycle in our area, in specifically Knoxville, in that area, we are looking for assets that are a little bit newer in this part of the market cycle. Now, back in 2013, assets were so deflated, prices were so cheap that when you bought at those asset prices, you could rehab those properties, put significant capex in, and you had a lot of runway to go. Right now, you're buying, well, we think it's a peak. Everyone's thought it's a peak for the last 3 or 4 years, and it's been really high, but you're buying at an elevated price. What happens to put that capex? It goes even higher when the market decides to take a dip. Well, you're not covered unless you have long-term fixed rate financing where you can weather the storm. Can you weather that storm? That's why it's important. That's why if you're buying those assets that are a little bit newer, you may be paying a little bit more, but you're going to hold it for the longer term in this part of the market cycle, in this expansion and hyper supply. Whereas in the recession and recovery, you had a lot of syndicators buying these deals, and within 24 months, 36 months, they're buying them and flipping them, buying and flipping. That's what was going on earlier on in that part of the market cycle. So once you understand market cycles, you're looking at the strategies that you're employing. Right now for us in this part of the market cycle where you're in expansion / hyper supply, you need to have a longer frame time horizon to be able to buy these assets. Because if it does take a pullback and you do go into a recession for a year or two, you can hold these assets, weather the storm. Because one thing that I've learned from the coaches at Jake and Gino, only 2 times that you care about what an asset's worth: buy it and when you sell it. That time between, there's work to be done, that asset or refinancing. You need to do the work. What I want you all to do is down below, what do you think we are? What part of this market cycle? Where are you? What part of the market cycle do you think we're in? Because it's really important. We'd like to find out all different cities and all different areas. Like I said,
where is your city at, or your submarket specifically?
Exactly. And I live in Florida. In Florida, it seems as if there's a lot of expansion, not really hyper supply yet. So put down below in the comment section where you're from and what you think the part of the market cycle is. And hey, while you're doing that, just hit me up, jakeandgino.com. I'll send you a free copy, PDF download of Creative Cash. It talks about the 3 pillars of real estate. It talks about creative financing because as I see it
market
right now,
cycles in there too.
That's right. Debt's starting to pull back. And as debt starts pulling back in that market cycle, you'll say, wow, creative financing, it's there. It hasn't been as prevalent the last few years, but we're thinking that in the next few years and in the future, it will become prevalent once again.
I think it all depends on your goals too, because if you're like a syndicator that likes to get into a deal and get out really quick, interesting time right now, because so many of those guys were doing the floaters and they're out there floating their debt. And now all of a sudden you see a huge rate spike that changes the game a little bit at times. So you got to be careful there. That's, for us, we're always looking long term. And, if we pay a little bit more for something, we have a minimum of a 10-year horizon to execute a manage right strategy to ensure that the deal is going to be able to pay us and the value is going to hold, to Gino's point, when we do come up for that next refi. So I think it's critical that when you're looking at a market cycle, you're also looking at your goals and trying to find alignment there. That's a crucial part to this. And, I think just to recap it, look, in the most recent times, you saw recession in 2008, to Gino's point. We used creative financing. You saw a trough, as Gino likes to say. Following that, it was a little stagnant. People trying to peek around a tree, see what's going on. We started buying right around that trough period. You saw some recovery starting to take place, people going out to shop again, but to the demographer's point that we spoke to earlier, you may not see that right now because it comes down to supply and demand. So as we're in this massive expansion period, we think massive, we really haven't had the numbers in terms of new builds to support the demand. So that's the difference right now that we're experiencing. So when is the peak? When is the hyper supply? The guy that we had on is saying it's not going to be for 10 years. Do I know that to be true? Do I know that to be right? Do we know what the real immigration numbers are? Do we know how everything's affecting it? No. I think it's key to be an expert on your markets, to understand supply and demand in your markets, to understand comps in your markets. And if you get very spread out, it gets more challenging. So be an expert, put the time in, understand pricing, supply and demand in your market. And I think it's going to serve you very well. G Papa.
Jake, just because you said trough, you got to give Jake
Trough.
the like button. Trough. One last thing that Jake said that's really important, everybody, and I want you to take this to heart. It's truly important. What are your goals? In the three pillars of real estate, let me reference that again. It's market cycle, it's debt, and that last one is so crucial that's what we made mistakes on. It's exit strategy. What is your exit strategy? That's going to help you with what kind of assets you're buying in this part of the market cycle. So let's put all three of them together. Every time you're underwriting a deal, what are you doing with that deal? Are you going to be holding it? You're going to be flipping it? You're going to be refinancing it? What does that look like? It's truly important. So once you put all three of those together, then come over to Jake and Gino. We can teach you how to buy right, manage right, and finance right.
Beautiful. I'm Jake. He's the G Daddy, and we make it happen. We'll see you next time. Thanks so much.